Today in Finance YouTube, there are so many dividend-focused channels. These channels rather focus on dividend income and yield more than total returns over the long term. And I'm not saying there's anything wrong with that, but everybody's circumstances are different. This has led to a lot of alright businesses and stocks really being overblown and overhyped by some of these channels, and especially the dividend investing community. So today, I'm going to be sharing two stocks that I think are completely overrated. This does not mean that these stocks are bad whatsoever. I'm just rather saying the hype around them is really just overblown. Before we get into the video, check out the Do Dividend Stocks Not Drugs merchandise, the best looking merchandise in the investing community today. Check it out, the link's in the description. Thank you, and of course, roll the intro.
Hello, I like money.
Apologies to Pierre from PK Investing, but you might want to click off right now because of course stock number one is Johnson & Johnson. Now if you go back and watch my videos from a few years ago, I was gassing up this stock like it was the next big thing. Unfortunately, I think Johnson & Johnson's a solid business, but it is so overhyped and overblown. To start off, I think that security part of it is really a huge thing. A lot of people don't like volatility, they don't like when stocks can fall fast, they like more something of a staple, which Johnson & Johnson definitely provides. Now, unfortunately, being a staple has allowed them to underperform the S&P 500 by around 60% over the last 5 years. Now, Johnson & Johnson is pretty much good every year for 4% dividend growth and free cash flow growth about 2% every year. It's really nothing to write home about. When you're on my time horizon for investing, that's just unacceptable performance. Johnson & Johnson's a stock that I'm likely going to be selling out of soon. Johnson & Johnson is also hyped up for being a dividend king and paying for over 60 years. Look, as I've evolved and have grown as an investor, this China has just matured and realized that Johnson & Johnson is a retirement stock. There's not a lot of volatility, but there's also not a lot of growth and not a lot of upside, and I'm just going to be underperforming if I continue to hold this stock. I'm not saying it's a bad company whatsoever, but there's limited growth ahead of it where it's at in the company. I just think it's really overblown by a lot of investors. It's such a behemoth of a company, but at the same time, there's just not a lot of growth ahead of it. Over the last 5 years, Johnson & Johnson stock is only up 24.18%. Now, something important to keep in mind here is this is not total returns, but I'm sure that the total returns chart is not going to have them outperforming the S&P 500, so keep that in mind. Unfortunately, Seeking Alpha does not allow you to compare Johnson & Johnson and the S&P 500's total returns, so my apologies everybody, but unfortunately, they've just been really lagging this last couple 5 years. Of course, it has gone up, but it's really just slow and limited growth. For me, if I could just buy the S&P 500, I'd have so much more gains over time, or some of the other core holdings in my portfolio. But during the last 5 years, the S&P 500 was up 80.68%. So a lot of people just in America invest in the S&P 500, even if they know nothing about investing, and it's really the best way to grow your wealth if you don't want to get into the deep loophole of picking individual stocks. At the end of the day, though, Johnson & Johnson has limited growth ahead of it. It's really overblown by a lot of investors, especially for that dividend king status. Just because a company's been paying a dividend for a long time and increasing it does not mean that it's going to continue doing that, as we've seen with Walgreens recently, and it does not mean that it has a lot of growth and will make you the most amount of money over the long term. Something huge to keep in mind, and a lot of dividend yield-focused investors will keep this overblown. The most important metric in any business when you're looking at its financials is free cash flow, of course, and we can see with Johnson & Johnson's free cash flow growth, it's just been barely anything. Pretty much 2.5% growth for the last 5 and 10 years. As I mentioned, just very limited growth ahead of it, and I don't see how that growth is going to be expanded anytime soon. So Johnson & Johnson, unfortunately, is probably going to be sold out of my portfolio. When I began investing, and especially dividend investing, I wanted to have a mix of companies in my portfolio. But as a really grown investor, I need to realize that I need to have those core positions really just make up my entire portfolio of businesses that I really believe over the next 50, 60, 70 years will compound into absolute free cash flow and dividend machines for me. A lot of people like to invest in Johnson & Johnson for their dividend that they've been paying for the last 61 years. But of course with the dividend, the growth is actually pretty solid, especially for a mature company, but there's so many better options for me in my circumstances. And once again, total returns at the end of the day. Any company can have a big dividend yield, but if their price appreciation is 20% over the last 5 years, you could just do better with an S&P 500 index fund. Over the last 5 years, their dividend growth rate's been 5.75%. When you're buying Johnson & Johnson, there's a giant trade-off between growth and stability. And you're trading off basically a lot of growth and a lot of gains to be had and a lot of wealth to be made, basically just for stability and the fact that it's not going to crash when stocks go down. So I don't love that. At the end of the day, stocks are going to go down. You should be happy when stocks go down so you could buy more. I've said it on the channel before, every year Johnson & Johnson is pretty much guaranteed a 4% dividend hike, and for me, there's so many better options out there long term. So Johnson & Johnson is the first overhyped dividend stock on the list. Definitely not a bad business whatsoever. There's a lot of stability there. It's not going anywhere for sure. But again, growth is going to be limited, and the giant trade-off there really makes it unappealing for me. So Johnson & Johnson is currently a smaller position in my portfolio. I own about 3 shares right now, but I am going to be looking to sell out pretty soon. The next overrated dividend stock is, of course, Coca-Cola, stock ticker KO. Now, out of the two, I personally would rather invest in Coca-Cola. A lot of people seem to think that Warren Buffett outperformed and bought Coke at all-time highs back in 1980 or whatever, when they had a lot more growth ahead of them. Now, Coca-Cola is still a very strong business, but a lot of their growth is going to be had by acquisitions these days. Over the last 5 years, not including total returns, of course, so keep that in mind. That's a big part of it. Coca-Cola stock is only up 26.05%. Once again, there's a huge trade-off between stability and growth here. And over this time, the S&P 500 is up 80.68%, once again, not including total returns. So you really got to compare apples to apples here. If you're 30 years old, 20 years old, and you're buying Coca-Cola stock over the S&P 500, you would have literally had almost 3 times the money if you would have just bought SPY. So sometimes it's just best to not oversimplify things. Like, just because Warren Buffett bought it doesn't mean that you need to buy it too. Coca-Cola is one of those most iconic dividend stocks. You're going to see it a lot, going on those dividend focused channels. A lot of older people holding their retirement portfolios. Once again, there's a giant trade-off, as I mentioned, between stability and not crashing during a market crash. And, it's always pretty much going to be here. But once again, that big trade-off, there's a lot of growth to be had in the future. And at the end of the day, it's best to just buy the S&P 500 index fund instead of trying to pick and choose individual stocks. Looking at Coca-Cola's free cash flow, once again, it's pretty solid, but it's barely grown since 2010. So that's a little bit of a red flag if you're looking for that free cash flow growth. As I've talked about, free cash flow growth is really just the principle of all those stuff that you want to get in your stocks: the dividends, buybacks, price appreciation, etc. Without free cash flow, none of that's going to happen. Coca-Cola's free cash flow is alright. They have a 3-year growth rate on it of 3.82% and a 10-year growth rate of 2.35%. You may ask why I'm leaving out that 5-year growth rate. It is a little inflated right now because I obviously see 19. There was a decline there. So that's a bit of an inflated number, but still quality growth here, but nothing really wild, and there's a lot better opportunities out there if you're 20, 30 years old. When it comes to Coca-Cola's dividend, once again, they're a dividend king as well. They've been paying for over 50 years. So once again, just because a company's been paying out for a long time doesn't mean that they're going to continue paying it or even have, better returns to the S&P 500. That's a bit of a silly, thought. They have a 3-year growth rate on the dividend, 3.91%, a 5-year growth of 3.36%, and a 10-year growth rate of 5.09%. So once again, just not really good growth at the end of the day when you're looking for dividend growth, and not really good with inflation either, especially a few years ago. That would actually be under inflation. So you'd actually be losing money there technically on the dividend, so nothing great you'd love to see with the growth rates. So those are some of the most overhyped dividend stocks in my opinion. They aren't bad businesses whatsoever, but once again, if you would have just bought the S&P 500, you'd have pretty much 3x your money. A few honorable mentions here. I think 3M, Realty Income, and Walmart were also 3 stocks that could have been added on here definitely, but I decided to go with the main 2 here. I think those are all businesses that are very quality business at the end of the day, but once again, they all share that kind of a trade-off. I want to thank Dividend Data for sponsoring today's video. That's the investing software that I used and showed in the video today, so go check out my link in the description if you want to check that out. Greatly helps support the channel. Alright, thank you all for watching. Let me know in the comment section what are your most overrated dividend stocks and why. Thank you, and of course, do dividends, stocks, not drugs. Have a good one.